Welcome back to Alternative Investing. I'm here with David Kaufman, President of Westcourt Capital, and David and I have been talking about using real estate for growth as an alternative investment. Now we're going to talk to a specialist in the field, Jeffrey Olin, President and CEO, Vision Capital. He's here to tell us how his company invests in real estate. Great to have you here.
Thank you.
Could you give us a quick summary? What does Vision Capital do?
Vision Capital is a manager of 3 funds that are focused on the real estate sector. We have an opportunistic approach involving long, short strategies. We do take concentrated positions selectively in our best ideas, and we seek to be active investors where appropriate to add value to our investee companies.
So you'll give management a hard time sometimes?
We try not to give them a hard time, but contribute to their effort.
And what's performance been like since inception for these funds?
We've had a pretty strong track record. We launched, we're now into our 3rd year, well into our 3rd year, and we are up, I think, 87% is the number since our launch, July 2nd, 2008. So we've significantly surpassed all the benchmarks, whether they're broad market, hedge fund, or real estate index benchmarks.
Okay, so you launched in July of 2008.
Yeah.
I think we can all remember that was a moderately turbulent time in the history of the markets. And notwithstanding the timing, you're up 87% since then. So, and yet we have everybody rushing for yield. Like, what's going on?
Well, this is not a new phenomenon, and it certainly goes through cycles and resurges. I mean, you recall the income trust era where there was a fever for yield, as you put it. And entities were going to the bank to borrow money to pay their distribution. So you got to be careful with yield, for sure. But real estate, the fundamentals are solid. Supply and demand, as I watched your earlier part of the segment, is in balance. We've had limited new development. The economic platform in Canada is fairly solid. The government's done a good job. We now have employment levels back to where they were before the recession. So the fundamentals are sound, and the real estate companies are well managed. They don't have too high debt levels, and so it's a fairly good environment for real estate securities.
I mean, we hear about the Canadian consumer with this debt load that amounts to 140% of income, a record high. I mean, isn't that an overhang on the real estate market?
Well, there's some concern on the single-family market for sure that's having an impact. We don't have much exposure to the single-family market directly, but certainly to the extent it's impacting consumers' purchasing power, it may have an impact. We haven't seen it. Certainly the most direct impact would be in the retail arena, and so far the retail names have held up quite well.
Okay, so this show is called Alternative Investing, and we always talk about the purpose of considering alternative investments. Decorrelation from the public markets is a big one.
Indeed.
Now, you typically trade in publicly traded companies, so how do you avoid being over-correlated to the public markets at large?
Yes, we invest in equity and debt securities. Part of the answer is we can be long and short. Mm-hmm. We tend to focus on value as opposed to yield. We focus on total return. So yield can be a component of it, but we're also looking for capital gains. And the correlation of our fund to the index is about half of what the correlation of the real estate index is to the stock market index broadly. So that's about 90% correlation in the index, and we're about 50% correlation. So we've managed to do it by stock picking, by, as you put it, macro, looking at supply and demand factors, by asset class, by region, and finding those opportunities in asset classes with good management teams.
You sometimes short.
We do. And we tend to use our shorts more often as a hedge. Mm-hmm. So we might go long one name that's relatively undervalued and short one that's relatively overvalued.
So to make this simpler to understand, can you give us an example of how a process worked for you?
Sure. Well, the largest holding we've had in our fund since we launched, and anybody that cared to listen to us would have found that the largest holding in our fund were the common shares of a company called Parkbridge Lifestyle Communities, Inc., an interesting business, manufactured housing community business. They're like apartments, but better in the sense it's more pure cash flow. And we were telling folks, even though they didn't pay large yield, that there was tremendous value. It was trading well below its net asset value, and our view was validated on the 4th of October. BC Pension Fund announced the proposed acquisition of Parkbridge at a price of $7.30, a premium of 30% to where it was trading.
PRK on the TSX.
PRK on the TSX.
Okay, so just to understand, so that's interesting. So they had rents coming in. It's just that what they did with the rents was different. They didn't say, okay, we're going to pay this out to our investors. They reinvested it for growth.
They reinvested it for growth in both income producing directly in terms of new acquisitions, as well as expanding some of their current properties, and they've done a great job.
When you're looking for undervalued assets, what do you look for? The worst house on a good street, to use an analogy?
We look for the net asset value of the real estate, the bricks and sticks, and how that net asset value compares to the share price. Is it too high or too low, the share price relative to the value of the asset? And we're looking forward. We're not looking at net asset value today, but where is it going to be tomorrow?
Actually, I'm always curious. We know that the cliche is when Starbucks moves into an area, the area's on the way up. If you're looking, say, at a retail property, what are the signs you look for in an area?
Well, certainly traffic flow is one. What is the traffic flow in the area? What is the income profile of the consumers within the trade area? What is the competition of that center? You might have great trade area and great income support, but if there's 4 shopping centers all competing, maybe it's not the best. You look for position of influence. You look for strong management. You look for aligned management. So there are a number of factors. There's not one single factor.
So does that mean that on a macro level there might be entire geographies that you would just stay away from because you don't like the story?
Absolutely. We started a macro view. What asset class do we want to be in? What region? And that's one of the beautiful things you asked about compared to real estate. You could be the best office guy in Toronto, tenant relationships, political relationships, brokerage relationships. But if the Toronto market is getting soft, you say, I should do this in Calgary. Well, it might have taken you a generation to develop that expertise in Toronto. It's difficult for you to replicate that in Calgary or Vancouver. If we're bullish on Alberta apartments, we can be long Boardwalk. If we're bearish on Toronto apartments, you can be short, TGA, Transglobe, REIT. You can do that in 5 minutes with low entry and exit costs with best-of-breed management.
What about I just want to run this past you. The thesis we've heard that small-town Canada could be in for a boom as the seniors move there if they have low crime and good hospital facilities. Do you ever look at things like that, regional centres?
Absolutely. Believe it or not, there's a couple of REITs in Canada that are focused almost exclusively on Fort McMurray, which has been a boom town. So, we've looked at regional plays, and we're not shy to invest in them if we think that the supply and demand metrics are compelling and the management is strong.
Okay, so at the fund management level, talk to us about IFRS, the International Financial Reporting Standards rules that have come in, and how has that affected you as a manager?
It's material. IFRS, for those that are not familiar, what it will do is it will change the accounting standards. Historically, we've had book-based accounting. If you've bought a building 40 years ago, it's depreciated on your books, so the value may show low on your books, but the market value may be significantly higher. And IFRS will capture that difference. And so some of these entities that are not well followed by analysts, maybe because they don't do corporate finance business or they don't trade very, very often, may be under the radar screen. And IFRS will highlight that value and will help pinpoint that differential.
A more accurate NAV, in other words?
More accurate NAV, exactly.
Now, let's have a look at Parkridge. PRK, obviously that one jumped, and obviously when you see a pension fund, it's a classic pension fund type asset. Not a bad jump there, and that stock's shortly going to be taken off the market. You have one other stock idea for us, EDU. Tell us about this one.
EDU is a recent new investment in terms of disclosure. We are the largest public shareholder, and I am on the board of directors. Again, we're looking, this is a long-term opportunity. We are looking at a 2 to 3 year minimum time frame on this. They're consolidating the childcare industry in Canada, which is the only Anglo-Saxon country in the world where consolidation and professionalism of the industry hasn't taken place, and there's a huge demand exceeding supply imbalance, and Elian is the first Canadian player to pursue this goal.
This was controversial in Australia, I think, when the childcare industry started being consolidated by private
Well,
companies.
it wasn't controversial in terms of the operations.
No.
What was controversial is the largest company in the world basically went from about $100 million in debt to over $1 billion of debt right at the wrong time during the credit crisis, and so they put on too much debt, and that caused the company to have some challenges, but the operations have been solid, and the Milken family has bought some of their assets, and largest operator in this space in the world is Michael and Lowell Milken, and other Morgan Stanley bought some of their American assets, and the founder of Macquarie in Australia bought some of the Australian assets.
Now let's remember that we are talking here about investments, not speculative trades.
Absolutely.
Long term.
Absolutely. Anything we do. We do some short-term trades, but that's not our focus. We are looking at opportunities that typically take 18 to 24 months to help surface the value and liquidity.
Good stuff, Jeffrey. Thanks very much indeed.
Thanks for having me.
Jeffrey Olin, President and CEO of Vision Capital. Well, coming up, it's time to hear from you, the viewers. Last week's show on Managed Futures got a lot of you talking. David will be answering your email questions next on Alternative Investing.